So we will pick up here with this unearned revenue. Again, we're just plugging through these examples where we have different types of current liabilities and understanding how we account for those current liabilities. This one should be a review because we've talked about unearned revenues before, right? There are circumstances where a customer may give us money before we've done anything to earn it. We have not provided any services. We have not sent them any product. Okay. So in this case, on June 30th, your favorite music artist sells $900,000 in tickets for 3 concerts. They have not sung a single song at this point in time, right? So on June 30th, they would have to make an entry in their accounting records that reflects the $900,000 of cash that they just collected for selling out the tickets to those 3 concerts. But again, they haven't done anything to earn that $900,000 yet. So what would be the entry in the journal that we would make for that transaction? Trace? Perfect. And again, we have done this before. We have also updated our unearned revenue based on the fact that we performed some of the work. Okay, so in this case, on October 31st, 1 of those 3 concerts was performed. Okay, so if we assume that the same amount of ticket sales accumulated for each of the 3 concerts, okay, we would take our $900,000 total amount and we would divide that by 3, right? Because that would indicate to us how much does each individual concert earn in revenue. 900,000 divided by 3 gives us that $300,000 amount. Okay. So now October 31st, 1 of those concerts is over. And so the artist gets to account for that as revenue now. What is the entry that they would make in the journal to account for that 1 concert having been performed? Kayla. And you can call it concert revenue or something if you want. It doesn't matter. But revenue. That's it. After the second concert happened, they would do the same thing. After the third concert happened, they would do the same thing. After the 3 concerts are over, how much unearned revenue should they have on their accounting records? 0, right? The 3 concerts are over. They have earned all 3 of that set of concert revenue. Unearned revenue should be gone. 0. Yes? This is a review, right? We've done this before. We've done unearned revenue before. Any questions about this? Okay. Let's get to something that we haven't done before. So we have identified the fact that there is this other type of current liability, right, that we can call notes payable. But notes payable is real similar to accounts payable. There are 3 main differences between that distinguish for us an account payable from a note payable. What's one of them? And yes, they are on the slide. What's one difference between an account payable versus a note payable? There's a contract in place. We call it a note. That's why it's a note payable. Yeah. You pay interest on a note payable. Grayson. It's typically for a longer period of time. That's why they're making us pay interest, right? They are making us pay interest because remember, in chapter 7, we were on the receivable side of this. It was great. We were getting interest. Now we're on the payable side. We have to pay interest. And the reason why we have to pay interest is because they are giving us a longer period of time to pay off what we owe. So they are going to associate interest along with the amount that we owe. Okay. So here is our first scenario. On June 24th, we received consulting services from McGraw, a total of $6,000. Credit terms are net 30. Let's just stop there. Okay. We received consulting services. We didn't give consulting services. We got them. Okay, so someone came and helped us with our financial planning. Someone came and helped us with our advertising plans. Someone came and helped us with something, consulted us with something, okay? And we owe them money, okay? It's not a note yet. You don't see anything in there about a contract, about extended time, about interest. On June 24th, we just owe regular old money, okay? What would be the entry you would make in your journal on June 24th for those consulting services that we just received and we owe money for those consulting services? Someone raise their hand and tell me, what is the entry that you would make on June 24th? You received consulting services, you're going to pay for it later. Trace? Sounds good, except I don't know what consulting services are. Well, we use them already. They're consulting services that they already provided to us. So it's an expense. Make sure that you indicate in sort of arbitrary account names, you got to make sure that you put what it is, right? So that would be consulting expenses or consulting services expense. I don't care. Just make sure expense is in there, right? This is an expense because it's something that we already use. We already got those services. They helped us with our financial planning or our advertising or whatever it was. We already used it. It's an expense. Yes? Okay. Now, on August 23rd, we are past due on our account. We were supposed to pay in 30 days. We are past due. So we call up McGraw and we say, hey, let's cut a deal. We know we're past due, but we need a little bit more time to pay off the entire amount that we owe. So on August 23rd, here's the deal that we cut. We will pay $1,000 right now. We owe them $6,000. We'll pay $1,000 now. Yes? How much do we still owe them? $5,000. And with that $5,000, you give us 60 days. We'll pay off what we owe, and we'll pay you interest. That's the deal that we are cutting on August 23rd. Does that make sense? So we're going to give them $1,000. We got to move our account payable. It's now a note payable for $5,000. And then later on, we're going to have to account for our interest. Okay. So on August 23rd, we have to make an entry in our journal that shows that we paid $1,000 and that the remaining account payable is now a note payable. Are you with me? How do I do that? Someone who hasn't answered me yet. What's one thing that I would do in my journal on August 23rd? We paid $1,000. Our account payable needs to become a note payable. What's one component of that entry that we would make on August 23rd? I even gave you candy. You got sugar in your system. Let's hit it. Josh. Yeah. Absolutely. Trace. Give me one. Okay. So we are showing on our accounting records that we made a down payment of $1,000. We paid off $1,000 of what we owe. The remaining note payable is for $5,000. So what's the debit need to be, Tim? Absolutely. So we are essentially removing the account payable from our accounting records. It's now 0. but we're still showing that we owe $5,000 with that note payable amount. Are you with me? Any questions about that? August 23rd. On October 22nd, we pay off what we owe with interest. We pay off what we owe with interest. So let's figure out what our interest calculation would be. You should have little cells outlined in column G there of your Excel spreadsheet. Let's calculate what our annual interest would be associated with this note. How do I do that? Annual interest amount. Manu. Yep. Notice he said 5,000, not 6,000. We don't owe 6,000 anymore. Now we owe 5. 5,000 times 12% gives me my annual interest. But I haven't had this note payable outstanding for 12 months. I've only had it outstanding for 2. Okay. How do I turn that from 1 year of interest to 2 months of interest? Tyler? Yeah, I can take that. 2 over 12 is my fraction of the year. So $100 is the amount of 2 months of interest, right? I could have also taken 600 divided by 12. That would have given me monthly, and then taken that monthly and multiplied it by 2. Either way you do it, you should come up with $100. That's how much our interest amount is. Okay. In chapter 7, we had interest revenue. What are we going to have in chapter 9? Well, no, because we're going to pay it. We're going to pay for it right now. I thought I heard it. I don't know where it came from. Interest expense. We had revenue when the money was owed to us. When we're having to pay it, it's going to be expense. Okay. So on October 22nd, we need to make an entry in our journal that's going to show that we are paying the $5,000 that we owe. So the note payable should go away, but we also owe $100 of interest. Okay. What needs to go in that entry on October 22nd? Tim. How much is our note payable worth? So that's how much we want to go away. Are you with me? October 22nd, we are paying off what we owe. What? Does that make sense though, Tim? Okay. So debit note payable for the full amount, $5,000, gone. Now what? Yeah, go ahead. Cooper. Interest expense. I'm modifying it. It's a debit. Expenses always decrease equity. Interest expense is going to be a debit in our accounting records. And then we need a $5,100 credit to make our journal entry balance. Cash. So, Caleb, that's why it's not a payable, because we're paying. Does that make sense? Had we accumulated interest and not paid it yet, then yes, we would have interest payable, because payable always represents amounts that we still have to pay off. When you see expense, you think we use something, right? What did we use in this case? Time. We used time to keep that money in our pocket longer, right? And then we paid it off at the end of the 60 days. So interest expense is being accumulated because we're using that time in order to give us a cushion for having to pay off what we owe. Okay. So this is an example where we originally had services, something that we owed, a regular old account payable. And then when it came time for us to pay off what we owed, we needed a little bit more time. We had to call up that other party and we had to ask, hey, can you give us a little bit more time to pay off what we owe? They said, sure, but we're going to charge you interest. Okay, that's this scenario. Let's go through another scenario with note payable. Let's say that we just borrow money for a short period of time from a bank. Okay, so on September 30th, the company borrows $2,000 from a bank, 12% interest for 3 months, just a short-term loan. We just need a short-term loan. Okay. On September 30th, so if you toggle over to the next tab in our Excel spreadsheet, here's all of our information. On September 30th, I need to show that I received that $2,000 and I'm going to pay it back later. How do I show that in an entry in my journal? How do I show that in an entry in my journal? What did I get? Yeah. I got $2,000 cash. I have to pay it back later with interest. So what's the credit going to be? Yeah. Yeah, no payable. So this is just, we took out a short-term loan. We got cash in our pockets. We're going to pay it back later. Okay. On December 29th, the company pays off what they owe plus the interest. Okay, so 3 months have gone by. We've had our short-term loan. And now this shouldn't say, oh, this should say 90 days. Sorry. 90 days. And this should say 3 months of interest. I apologize. We're going to pay off what we owe with interest. Okay. So how do I calculate the starting point of annual interest? How much interest would I owe if this was outstanding for a full year? What's the calculation that I'm going to do? Yeah, how? Yep. 1 year of interest. But I didn't have the loan for 1 year. I only had the loan for 3 months. Trace? Absolutely. Right? 3 months of interest. That's how much I owe, because that's how much the loan, or that's how long the loan was outstanding. 3 months. So what is the entry that I would make in my journal when I pay the amount that I owe plus interest? My note payable should go away and I should account for that interest expense. Tyler. Okay. Yep. That's it. So the way that we pay off the loan is the same way that we paid off what we owed in the previous example, right? You debit the note payable, you want that to be 0. You debit your interest expense for the amount that you had for the months outstanding, not the full year, the months outstanding, and then you credit your cash for the combination of the two. Okay. Everybody cool on this? All right. We discussed this briefly in chapter 7, but I'm not going to have you do an example of it. But we talked about the fact that when your note, whether you're talking about a note receivable or a note payable, when your note straddles over 2 accounting periods, at the point that those accounting periods change, you have to make an adjustment in your accounting record. Okay. So if we had a loan outstanding as of November 1st, and we didn't pay it back until March 1st, that loan is straddling 2 different accounting periods, right? Accounting period 1, accounting period 2. On December 31st of that first accounting period, you would have to make an adjustment. How much interest do I owe right now based on the last couple of months that I've had that loan outstanding. Even though I'm not going to pay it until the next accounting period, on December 31st, when year one is ending, I have to make an adjustment in my accounting. Okay. The rules say that you have to adjust for that. We went through a very brief example of that in chapter 7. You're not going to see that on any exams or any quizzes, but I just wanted to make mention of it to you again, things that you kind of, you sort of deposit in your accounting memory. And if you're taking future accounting classes, these things will come up again. Okay, so payroll liabilities. The payroll liabilities can become very confusing because if you think of an organization, you would automatically just assume, okay, well, yeah, there's liabilities that they have, right? Hiram College has a liability to pay me my salary. That's their liability to their employees. But there is an additional liability that companies will have related to their employees. Because when Hiram gives me my paycheck, is it a gross amount or is it a net amount? And what's the difference? Anybody ever got a paycheck before? Do you see a gross amount that's a lot bigger than a net amount? Which amount do you get in your pocket? The net. What do they take out? Taxes. Right? For me, not only do they take out taxes, but they take out retirement fund contributions. So every pay period, I take a percentage of my income and I allocate it to my retirement fund, right? Every single pay period. Okay. But the amount that I get in my pocket from Hiram College is that net amount. Hiram keeps the taxes, local, state, federal. Hiram keeps my 401k contribution that I've determined I want to put into my retirement fund. Hiram keeps all of that. Okay. But does that money belong to Hiram? No. It belongs to my 401k and it belongs to the federal government or the state government or the local government. Are you with me? So the same idea that we talked about with sales taxes, where Home Depot collects the money from the customer and then they have to take the sales tax portion of that and give it to the government. Employers have to do the same thing. So oftentimes students will only think of payroll liabilities as the paychecks that they have to give out to their employees. But there's this second category of payroll liabilities. Hiram is keeping all of that money and it doesn't belong to them. So until they give that money to the government or to my 401k, Hiram has a liability on their accounting records for that money that they have taken from my paycheck that has to be given out to these other parties. Does that make sense? So again, very similar to the sales tax example, not anything that we are going to go through in specific detail in terms of journal entries, okay? But just understanding that not only, I actually missed this one, my medical premiums, my health insurance premiums. Hiram takes that out of my paycheck, right? Hiram doesn't give me a gross amount and then I write a check to the insurance company for my premium. And then I write a check to my 401k. And then I write a check to the federal government for taxes. And then I write, no, they do that for me, right? And so they take out money for my my medical and dental benefits, the premiums that I owe, and they hold on to that money and then give it to the insurance company at whatever appropriate time, right? So there's a variety of different reasons why your gross pay is different than your net pay, right? And a lot of those reasons, your employer will keep those funds and they will essentially remit them to the appropriate body for you so that you don't have to do that. Until they do that, until they send the money to my 401k, to the insurance company, to the federal government, those are liabilities that Hiram has on their accounting records. Not only do they owe me my paycheck, they also owe all these different agencies these other amounts that are coming out of my paycheck. Cool? Again, something just, I like to, these kinds of real world things. Most of you have gotten paychecks before, and now you sort of understand, not from your side of it as the employee, but from the employer's side of it, how it looks on their, or how it affects their finances, how it affects their accounting records. Okay. there are a variety of instances in accounting that maybe you didn't realize until you took this class, that we're allowed to guess. We're allowed to just make an estimation and say, yeah, that's what I think it is. You would think maybe from the outside looking in that that's not appropriate. But there are just some things that we don't know for sure. Things like depreciation. You don't know for sure how much the value of your asset has decreased over time. You have to guess. You don't know for sure which of your customers are not going to pay you, right? The allowance for doubtful accounts. You don't know that for sure. You just have to come up with a guess, okay? So those are examples where we are guessing, we are coming up with estimations related to assets. Things like long-term equipment and machinery and buildings and our accounts receivable. There are also some circumstances where we have estimates. We have to make a guess related to liabilities, okay? We're only going to talk about warranties, okay? I'm going to go through an example with you of a warranty, but I just want to, again, explain what these other types of estimated liabilities are. Pensions, okay? So my husband is a high school teacher, and so he gets a retirement plan from the school district that says when he retires, they will give him a certain percentage of his best year's salary. So let's say, this is not the case, but let's say that he makes 100 grand. I'm just trying to use round numbers. He doesn't. He works in a public school system. He doesn't. So let's say he makes $100,000. The retirement plan would say, okay, we agree to pay you 80% of your salary when you retire. So when my husband decides to retire, he would get income from that school district of $80,000 per year. Pretty good deal, right? But do they know when my husband's going to retire? Do they know how long my husband's going to live when he retires? No, hopefully a really long time. Right? But those are all guesses that that school system has to make to figure out how much do we owe John Armini for his retirement. They don't know for sure because they don't know when he's going to retire. They don't even know how much money he's going to be making when he retires. They don't know how long he's going to live in his retirement. They have to guess all of that. That's called a pension, okay? And we do that accounting for pensions in Intermediate 2. Other healthcare plans, same thing. If your employer offers you healthcare benefits upon retirement, there is no way for them to know how long are you going to get those benefits, what kind of health situation are you going to be in as to whether those health benefits are going to cost them a lot or not. They have no idea. But if they promise you health benefits, then that's a liability on their accounting record. They promised you, okay? And so they have to come up with an estimate for that. Vacation time, same thing. We don't know for sure when people are going to take their vacation time. We have to guess. We have to come up with an estimate based on historical information, based on trends that we see within our business or within our industry, right? How often do people take vacation time? And we have to use that historical information to help us guess. For this current period, what do we think we're going to see when it comes to our employees taking vacation? Because we owe them that vacation. That's a liability to us. We promised them that they could take vacation time. So we have to show that as a liability on our accounting. Okay. And then finally, warranties. How many of you have ever purchased a product that came with a warranty? And what does that mean? What is a warranty? Yeah. They'll replace it. They'll send you a part that you have to add yourself. They'll give you your money back within a given period of time, typically, right? That's what a warranty is. When those products are sold, does the manufacturer know for certain how many of them are going to break that they're going to have to replace? Josh? No, they couldn't possibly know that for certain. They have to guess. They have to guess. And the accounting rules say, use historical information to guess. How often do you think that product, you're promising those people that you'll replace it, you'll fix it, you'll give them their money back? How often is that going to happen? The accounting rules say they have to come up with a guess. Okay, so let's go through a quick example of what that could look like. Okay, on December 1st, a dealer sells a car for $16,000. The car had a cost of $8,000. So if you're a car dealership, your inventory are those automobiles, right? So even though other organizations would classify a car as a fixed asset, something that they would use for a long period of time, if you're a car dealership, that's your inventory. That makes sense? So 16,000 is the sale price, 8,000 is the cost of goods sold. A maximum 1 year, 12,000 mile warranty covering parts. Past experience indicates that that warranty typically accumulates to about 4% of the car's selling price. So what that car dealership would do is say, okay, in the past, when we sell a car like this, how often does something go wrong within 12,000 miles or 1 year that we would have to fix, replace, do something to accommodate that something went wrong with the car, right? How frequently does that happen? And how much does it usually cost? They can accumulate all of that information and come up with an estimate. That's where that 4% comes from, okay? So when the car dealership sells the car, what would be the entry that they would make for the sale of the car? Remembering that that car is not a car to the dealership. That's inventory to the dealership. And every time you sell inventory to a customer, how many entries should you make in your journal? 2, a sale entry and a cost entry. So what would be the sale entry that we would make, Hal, on December 1st? Absolutely. And what would be the cost part of that entry that we would make on December 1st? Tim. For the 8,000 given to us in the problem. What the accounting rules say is that if you sell a product that has a warranty, there's actually a third entry you have to make on the day that you sell it. That third entry is related to how much do you think that warranty is going to cost you, right? So again, they come up with their estimate and they say that about 4%, so 4% times the sale amount, $16,640. So based on our historical analysis, we're able to determine that about $640 is what we are estimating we might have to spend to make good on that warranty. They have to bring it back in, we have to fix a part, we have to send them something, whatever the case may be, $640 is our estimate. On that day that they sell the car, not only do they have to show an entry for the sale of the car and the cost of the car, they have to make a third entry for the warranty related to that car. That is going to look like this. Debit warranty expense, credit warranty payable for $640. You are anticipating that you're going to have this liability of $640, okay? And over time, we may change our guess, right? I told you that before in the other examples. You're allowed to change your guess. You're allowed to make an adjustment to say, you know what? It's actually more like 8% of the total price that we end up having to spend on these warranties. You can adjust that over time, no problem. But on the day that you sell the car, on the day that you sell the inventory, the product, you have to record entries for the sale of the product, the cost of the product, and the warranty. Just like that. Everybody cool? So warranties. Okay, this is just a example of sort of the thought process that we go through. So this is the last slide in chapter 9. The thought process that we go to when we have a liability that we're not really sure about, okay? That's called a contingent liability. A liability that is dependent on something else happening, and we're not sure if that something else is going to happen or not. I'll give you an example. A lawsuit, right? We're being sued. And we have no idea what the results of that lawsuit are going to be. But if we lose, we owe money. That's a liability, right? And so what we have to do from the accounting perspective is we have to assess two things. Number one, can we estimate what the amount of that liability would be, right? And so for a lawsuit, can we estimate how much we would owe? If we lose this lawsuit, if we lose in court, can we estimate how much we would have to pay? That's number one. Number two, what is the likelihood that that event, us losing the lawsuit, is actually going to occur, right? Is it remote? Like there's no chance, they have no case, it ain't happening. We don't have to do anything on our accounting record. Is it possible? We don't have to actually make an entry in our journal if it's only possible. We just have to include it in the descriptive notes of our financial statements. Okay. But if it is probable, so these are the likelihood, again, the likelihood that that event, us losing the lawsuit, will actually happen. If it's remote, meaning there's really no chance that it's going to happen, we don't have to do anything. If it's possible, inching our way up, it could happen. And we know about what the amount would be. We have to put that in the detailed notes that accompany our financial statements. But if it's probable that we are going to lose, we would have to make an entry in our accounting records for that liability. The rules say if you have a probable liability, even if you're not sure, if you have a probable liability, you have to make an entry in your accounting records for that probable liability. Okay. Again, little nuggets that I like to introduce to you in this chapter. I'm not going to ask you to make any entries for a contingent liability. Just information that I want to present to you to sort of think your way through some of these more complicated types of accounts that you may eventually see in other classes. Okay, contingent liabilities. Everybody cool? Okay, so with that being the end of chapter 9, we are ready to move on to the additional practice problems. So where are those? Oh, I need to make them. I think I need to make those available to you. Hang on. There they are. In the chapter 9 section of Moodle, you will soon see chapter 9, additional practice problems. When you open up that spreadsheet, so again, chapter 9, additional practice problems. When you open up that spreadsheet, it should look like this. You have an unearned revenue problem. You have 3 note payable practice problems, and then you have a warranty practice problem. So I would like to spend the next 20-ish minutes of you all getting with each other, helping each other out to work through these additional practice problems. I want to spend at least the last 10 or 15 minutes of class starting to go through the solutions with you. And then whatever we don't finish today, we'll pick up with on Monday. Okay? So for the next 20 or so minutes, you're going to work with the folks around you to go through these additional practice problems for chapter 9. Again, related exactly like the ones that we just did in class together. Last 10 or 15 minutes, we'll start working through the solutions, and whatever we don't finish, we'll pick up with on Monday. Okay? Everybody understand what we're doing for the rest of class? Okay, go ahead and get started. Raise your hand. Raise your hand if you have any questions. And we are going to begin with this unearned revenue problem. So assume you're working for a landscaping company. You have a new commercial client on May 1st. That client gives you 50 grand in your pocket to provide landscaping services for May, June, July, and August. You need to prepare an entry for when you get that money on May 1st. And also when 1 month has gone by and you've performed some of those landscaping services that you promised. Okay. So someone raise their hand and tell me, what entry are you going to make on May 1st when you receive the $50,000 from this new customer? Yeah, please. You're on the wrong problem, I think. Are you on the unearned revenue problem? Okay, so we are performing landscaping services, right? So we are the business that's going to be providing landscaping services. And on this day, Ethan, all that happened is we got money from a customer and we haven't done anything to earn it yet. Does that make sense? So anybody, Jimmy. Make sense? Okay. 1 month has gone by. We performed landscaping services for 1 out of the 4 months that we promised to perform landscaping services. So we first have to figure out, well, how much work did, like, what is that? What is the value of that work for 1 month? How do I figure that out? Trace? So each month is worth $12,500. Again, assuming that we spend the same amount of time. Sometimes in the real world, it might fluctuate. We're going to make it spread evenly over the 4 months. Okay. So on May 31st, we have to make an entry because we have performed services for 1 out of those 4 months. We know that it's worth $12,500. We calculated that over on the side. So what is the entry that I would make in my journal on that day? At the end of that first month, when I've earned 1 month of revenue. D. And what's my debit? Well, wait a second now. So unearned revenue, right, is already 50,000. And I think what you just did is you want it to be 37,500. Does that make sense? So how do I get it from a credit of 50,000 down to a credit of 37,500? I would make a debit of that amount that I earned, right? Because when we make an entry, we don't have to make an entry for the new balance of unearned revenue. We just make an adjustment to get it from 50 down to where we want it to be. We want it to be down here at 37,500. So if we make a debit of 12,500 to unearned revenue, what we are essentially saying is this was 4 months of unearned revenue. We just earned 1 month. So what we have left is 3 months of unearned revenue. And we would do that at the end of June, and at the end of July, and at the end of August. And at the end of August, how much unearned revenue should we have? Nothing. 0. Sorry, calendar. No. Exactly. Exactly. How much we don't. Exactly. Okay. So decreasing the unearned revenue, making a credit to revenue to show the amount that we earned for that month. Any questions about this? So we have 3 different note payable questions. We'll probably be able to get through this one and then we'll stop and go through the other ones on Monday. Your company just engaged a new marketing consulting firm. Ethan, this is why I thought you were on the wrong tab. During August, you received consulting services worth $8,500 from this firm. So we got serviced by that firm. They provided us consulting services, right? They consulted with us on something. We already got the services. We're not getting them in the future. We already got them. 8,500. We agreed to a 4-month note that has 5% interest. So this isn't one of those situations where we had an account payable and then we have to move it to a note payable. This is just right off the bat, we agreed to a note of $8,500 that carries a 5% interest rate. So on we'll just say August 1st, didn't give a date. We received these consulting services. What would be the entry that we would make in our journal for the receipt of the consulting services and the fact that we owe them $8,500? Trace. Does that make sense? Okay. So we have this expense related to the consulting services and we owe them money. Now, in November, we have to pay off what we owe with the interest that has accumulated for 4 months. How would you go about calculating the interest amount? Where would you start that calculation? Tyler? Okay. And that represents what? That's fine too. Okay. You want to keep going? Yeah. Okay. Kayla likes to call these ugly numbers. That's fine. Numbers aren't always pretty. We could take these and you can have them as dollars and cents, or you can just round to the nearest dollar. I don't care. As long as you show your calculations in Excel, I'll be able to see what you did. Okay. So the amount of interest that we have to pay in addition to the $8,500 is $142. Okay. So in November, when we pay off our note and the interest associated with it, what would be the entry that I would make in my journal for that? One final question stands between you and the weekend. What is the entry I would make in my journal for that? Ethan. I love it. Thank you. Okay. So we have a couple more note payable examples. We have a warranty example. That is where we will pick up on Monday. We will jump right into this spreadsheet, plug away at those example problems. We will go through a short chapter 10 lecture, and then we will work on some more practice problems. On Monday, I am going to require that you work with at least one other student. So if you are by yourself, I'm going to ask that you move to a place where you will be working with another student. I want to hear you talking about these things, bouncing ideas off of each other, working together, using each other as a resource, as well as me, to go through these practice problems so that we are all prepped and ready to go for the final. Okay? I appreciate you, and I will see you on Monday. Yeah. See ya.